Hey everybody, Smart Silver Stacker here. The Federal Reserve just came out with its biannual financial stability report, and this one I think is one that we should all be paying attention to because there are some warnings in here that the Fed has given us, and I believe that they may be a foreshadowing of what is to come. The Fed may be setting the stage for a reversal of its tightening policy in this document. So let's go ahead and get right to it. We'll take a look at what I am talking about. Now, this is an 86-page document. I'll put a link to the PDF down in the description for anybody who wants to take a look at it, but there's just a few paragraphs really that I want to pay attention to today. And I'll go ahead and start with this one. Recent liquidity strains across U.S. Treasury, equity index futures, and oil futures markets. Market liquidity, the ease of buying and selling desired quantities of an asset, is an important indicator of how well markets are functioning. According to some measures, market liquidity has declined since late 2021 in the markets for recently issued U.S. cash treasury securities and for equity index futures. These markets play important roles in the functioning of the economy and financial system and are usually highly liquid. Low liquidity in these markets can amplify price volatility and result in unexpected tightening in financial conditions. In extreme cases, such as the market turmoil at the onset of the pandemic in March 2020, low liquidity can impair the ability of the financial system to respond to a large shock, because investors may not be able to adjust their holdings of assets to raise cash or hedge risks, or they may be able to do so only at a substantial cost. While the recent deterioration in liquidity has not been as extreme as in some past episodes, the risk of a sudden, significant deterioration appears higher than normal. In addition, since the Russian invasion of Ukraine, liquidity has been somewhat strained at times in oil futures markets, while markets for some other affected commodities have been subject to notable dysfunction. Okay, so this is a warning from the Fed that liquidity is getting tight. And also, if you notice there at the end, they gave themselves a little bit of an out, kind of a ready excuse baked into this document with that bit about the war in Ukraine. And I believe that what the Fed may be doing here is foreshadowing what is to come, and they're setting the stage for a potential reversal of their tightening policy. If we do get a big liquidity crunch, I suspect that we may see some of these talking points in this document coming out of the mouth of Powell as he announces a return to QE, a return to stimulus. And if that happens, or maybe when that happens, I do suspect that Powell will also claim that the switch is only temporary. They'll say that none of this could have been foreseen, and so they just have to do it. Of course, that's what they always say in these crises. Now, if we get a liquidity crisis, maybe the Fed won't intervene, maybe they'll stick to their tightening. But if we judge from what they've been doing over the past 2 decades, that has not been the case so far. And I don't really see any reason for them to change their tune now. And speaking of a crisis, I do want to step away and take a look at markets and what's going on today because, a crisis might be closer than we think. But real quick, I also do want to say a big thank you to our sponsor of today's video, Silver Botanicals, household and personal hygiene products that utilize the power of silver. Head over to silverbotanicals.com. There's a link down in the description. And don't forget to use coupon code STACKER to save 10% off your order. Okay, so going over here and just taking a look at markets real quick, you can see we're having another rough day following the big pan sell-off that we had yesterday and Friday. This is a continuation today. And we started off green pretty much across the board. All the major stock indexes were in the green. They were up fairly significantly, but now it looks like all of those gains have been erased. All of the indexes down in the red, with the exception of the NASDAQ, which is pretty much just flat for the day. Of course, over the past 2 trading sessions, the NASDAQ has already gotten so beat up that I guess it just doesn't have as much room to fall as these other stock indexes. But markets can't go straight up or straight down forever, and I do expect that we'll get some kind of a relief rally or a dead cat bounce or, maybe a resume to new highs. Who knows with this market, although the Fed is kind of taking away the punch bowl now. Gold and silver, though, they were in the green to start the day off as well, and they are continuing their fall. Silver now right around that 2150 level, and that's a pretty important technical level for silver. If we drop below the $21 level, the next stop is probably going to be about $18, so probably be time to load up on some silver. Of course, not financial advice. It's just that, in my opinion, $18 for silver would be quite a steal, although I doubt you'd be able to find any physical metal for that price, but still might be able to get a little cheaper than we can today. And I do view even these prices, 21.58 physical silver right now, you probably get for about 25, 26 bucks. That seems like a pretty good deal to me. And if you know of any really good deals right now in the silver market, in the physical silver market, let us know in the comments below. But let's go back to that document from the Fed, because there is one other thing I want to cover. All right, and there's just one other paragraph here in the financial stability report that I'd like to share with you, also related to market liquidity. So it's titled, Market Depth Has Recently Deteriorated Across a Range of Markets. Quoted depth has decreased since 2021 for the interdealer U.S. Treasury securities, S&P 500 E-mini futures, and West Texas Intermediate crude oil futures. And so, yeah, treasuries, equities, and oil, those are pretty important asset classes. Anyway, initially in treasury and equity markets, the decline in depth reflected rising uncertainty about the outlook for monetary policy. In the treasury market, the decreases in depth were greatest for bonds with shorter maturities because the prices in those securities are more sensitive to expectations for monetary policy over the near term. In oil markets, depth has declined particularly sharply in recent months as a result of the elevated level of uncertainty and volatility associated with the Russian invasion of Ukraine. Recently, depth in these markets has been lower than is typical, even after taking into account the level of volatility, as shown for the oil market in Figure B. Let me scroll down a little here so you can see Figure B. This markedly low depth could indicate that liquidity providers are being particularly cautious and liquidity may be more fragile than usual. Declining depths at a time of rising uncertainty and volatility could result in a negative feedback loop, as lower liquidity in turn may cause prices to be more volatile. And also, we can take a look at this figure A here for market depth. You can see this is market depth in the treasury market over here, and also in equity and oil futures markets here on the right. And you can see that the market depth is getting to levels close to March of 2020. So that is pretty significant in all of those markets. And as far as a negative feedback loop, as lower liquidity may cause prices to be more volatile, yeah, in an economy like we have, where everybody is so leveraged up and there is so much debt, even a small decline can create this kind of negative feedback loop, because everybody is selling everything, everybody is trying to get liquidity, get cash. And as that happens, people are getting margin called. If we see an increase in volatility and stocks and assets are declining quickly, people with leverage, they are going to get margin calls. They are going to be forced to liquidate positions. And that is the negative feedback loop that you can see when markets are as fragile as they are. Now, the irony is that the Fed is responsible for all of this fragility. They've created it by keeping interest rates so low, allowing everybody to take on these massive debt levels and to get so levered up that they, become extremely fragile in the quest for yield in these low interest rate environments. And it's kind of like a forest fire, if you think about it. In a forest, there have to be fires every now and then to get rid of the dead wood and to get rid of the undergrowth. And it's even part of managing a forest in a right way. You allow some controlled burns every now and then if you haven't had a good fire in a while, because if every time there's a little fire, you just keep putting it out and putting it out and putting it out, finally, when one comes that it gets out of your control, you're going to have this raging conflagration because there is so much dead wood in the forest. So that's the closest analogy I can think of to the situation that the Fed finds itself in right now. But let me know what you think. Is the Fed setting the stage for a reversal of their policy? Because that's kind of what it sounds like. If we see a liquidity crisis, I definitely think that we'll hear Powell saying a lot of these same talking points as he announces a reversal of Fed policy. I definitely think that that is something that could be in the cards, but maybe not. Maybe if we see a liquidity crisis, the Fed will continue to tighten. I really doubt that, though. Let me know what you think in the comments below. Let me know what you're doing to get prepared for this type of potential crisis. Let me know what you think about today's action in the markets. Are we going to see a rally soon? Love to hear what you have to say. Thank you all very much for watching the video today. Don't forget to like, comment, and subscribe, and I will catch you next time. Smart Silver Stacker, out.